to Muhammad Lahir. He's from the Banking Association of South Africa. He's made his rounds, and I believe a lot of insight that the CASA has gotten on the different platforms with CIF, also trying to understand where credit providers come from and assisting to improve industry, especially in our debt counselling space. A lot has been left out in the last 11 years. So, Mohammed, on that note, can I hand over to you?
Thanks, Casper. Good morning to everybody. I think, welcome everyone. I think I'll structure my discussion around DCRS predominantly. Happy to take additional questions if there are, but my main engagement will be around DCRS. There's a couple of things that are happening, but maybe just to start off with the broader structure of DCRS. So, as you know, proposals are created in two fashions: the pro rata or non-DCRS version, and then the DCRS version. And obviously, DCRS hosts there's a host of advantages with DCRS proposals, particularly from acceptances by credit providers. And so there's huge benefit, I guess, to all involved, right? If you get full acceptance, you're able to approach the NCT, which we believe is a more swifter and certainly a more cheaper resolution than going to the merge court. So there are a host of advantages, and we do encourage usage thereof. How does BASA fit into DCRS? So BASA doesn't own DCRS. BASA merely facilitates and manages the day-to-day run in connection with an external system vendor or IT company. The concessions are owned by a forum called NISC, that's the National Industry Steering Committee, and that's made up of a bunch of credit provider associations who, I would say, represent the large bulk of the credit industry. So these members have agreed to certain concessions, and they will adhere to those concessions and ensure that you get your consents quite easily when you do follow DCRS. So that's kind of the backdrop of it. There's also then a DCRS CIF subcommittee where we have NISC representation, BASA representation, Debt Counselor representation, and importantly, the system vendor and PDA representation there as well. And that's where we kind of get together and discuss and agree developments to the system, usage of the system, and any other thing around DCRS. So that forum's been going on for many years, and I think it's run quite smoothly, as opposed to most of the other CIF subcommittees. It's very meticulously ran. So that's broadly the landscape of DCRS. Then I think Casper touched on both cascading and jumbo loans. So we're busy with a huge development called cascading. And if I simplify what cascading is it's just that when one agreement gets paid up, the funds utilized to service that agreement is now distributed to the remaining credit agreements. In your life as a debt counselor, that may well have already been happening through your system vendor. So what's changed is that now the system, being DCRS, will do that itself and factor that into the upfront calculation without your system vendor having to do this on their front end. So it may mean that in your lives, not much has changed, but in the back end, a lot is changed, and this will be done more proactively and have more positive results, we hope. So that's taken us a long time, and it's not just taken us a long time because we're just building cascading. It's taken us a long time because we used the opportunity to build in additional items into DCRS, like fees, PDA fees, debt counselor fees, reckless lending fees, application fees. All the fees that are regulated have been built in there. There's no caps inserted at this point, but all the fees are available in the system, and it's there for you to utilize. And that's now been done Again, no longer by your system vendor, but by the DCRS calculator, which should be more efficient going forward. I guess it also places all the system vendors on a level playing field now when coming to DCRS. So we encourage you to use it. We hope to go live on Friday, and that's quite exciting for us. It's been a long journey building all these fees and all the cascading rules into DCRS. It may seem simple from the front, but the calculation is quite intricate and it does require quite a bit of development work. So we've come a long way with the system vendors and our testers and super user testers, and we're just about ready to implement that in live. You as a debt counselor would still have the opportunity of selecting a non-cascading proposal. It won't have any benefit to you or the consumer, but the functionality will remain in place. Then in terms of what's coming up, once we've done and implemented the cascading solution in live, we will start building the PDA fees and the other fees into the non-cascading bit. That should happen concurrently with something that's quite important and something that we've done a lot of groundwork and something that Casper asks me of quite frequently, perhaps too frequently. And he's alluded to it as well, jumbo loans, right? So what's a jumbo loan? A jumbo loan is simply an unsecured credit agreement which was contractually taken out for a period exceeding 60 months, a repayment period exceeding 60 months. So, and we've noted that it has become more common in the market. When we built DCRS and when we built the task team and we all agreed to the concessions and the rules, there was no 61-month plus unsecured agreements. I mean, at that point, even 60-month agreements were not frequent, right? We're seeing 24-month agreements as the predominantly dominating the market share at that point. But we've moved along as a market and a credit industry, and we've opened up and expanded on the offerings to our clients. And so now we've got a more diverse offering, which includes longer unsecured agreements where warranted. Unfortunately, those were not catered for either in the concessions principally or even in the system, because we never foresaw that. We are now looking at trying to agree some industry concessions applicable to these types of agreements. So that's kind of the first part. And there's a lot of work that goes on into that, right? So we first need to make a decision. Is jumbo loans big enough for us to warrant inclusion into DCRS? And we've done a lot of work together with the CASA. I think Reinhard's previous tenure, he's done some work. Casper's done a lot of work, and the banks and credit providers themselves, I think, has done a hell of a lot of work on that front. So we've almost answered that question to say we should consider including it into DCRS. And then we say, if we say we are going to include this into DCRS, we need to identify and agree a bunch of concessions. And you'd recall I said to you earlier that concessions are owned by NISC, the National Industry Steering Committee. So that's the process we currently embarking on, is making this market analysis. How big of an impact is jumbo loans in the market? If we say we're going to include it, what are the concessions? And that's a lot of analytical work. I think maybe we don't always fully appreciate the impact of these things, but there's a hell of a lot of analytical and modeling work that goes on in the background, and we're not dealing with 5 banks or what it may seem on the front. We're dealing with thousands of credit providers that have to go and look at what the impact of these jumbo loans are on their books, right? And you don't want to break the credit market either by introducing something that doesn't work. So we're busy with that. That's happening. Then once we've done that bit, and I think as we've implemented cascading, we'll have more resource available to dedicate to things like jumbo loans. We'll then look at coming back to CIF with some feedback and seeing how we move forward with adoption of jumbo loans into DCRS. And then there's another thing, and it's loosely referred to as abuse, but I don't want to term it as such. But we have, however, from a credit provider perspective, noted many instances, if not the majority of the bulk of instances, where proposals are conducted to secure the maximum concession. Now, with respect, that shouldn't be, never should have been, or nor will it ever be the aim of what the NCA says or what we should be doing for consumers, right? Your function as a debt counselor is an intermediary. You don't act on behalf of a consumer. You actually have an independent function that you execute in terms of the act. And yes, there are aspects of it that where you deal directly with consumers, but there's also aspects where you deal directly with credit providers. Your aim and your duty should always be to represent most fairly and most accurately the current financial situation of the consumer. Now, what we've seen, and perhaps this is because debt counseling is so competitive, but what we've seen is that many, and I'm not saying it's all of you on the call, it's probably not all of you on the call, it's probably the guys that are not affiliated to big good associations that do good work in the interest of everyone, but we have noted that many debt counselors use the concession thresholds as a target. It's not a target, guys. The target is a fair representation of the consumer's current financial position, and that should be reflected in a repayment proposal, not what's the maximum concession I can secure in order to allow this consumer to pay off as little as possible. That's in no one's interest, not in the consumer's interest, not in your interest. And yes, it may buy you some marketing food, but it's not the right thing to do, and I think we should steer away from that. I know in the in-person DCRS meetings, Casper and team were quite diligent on this aspect, and they highlighted this aspect. So my plea to you then is to say, please, as far as possible, try and reflect the actual consumer situation, not aim to get the maximum concession so you can go to a customer, I can save you X percentage. That's not what we do, right? We help customers and we act fairly and without favor or bias to any of the registrants or consumers in the market. So that is something that impacts us, and credit providers are becoming more wary. And if it doesn't change, I do suspect credit providers will become more stringent. And I think we don't want to get back to a place where we have this antagonistic relationship between DC and credit provider. I think as an industry, we've come a hell of a long way, and I think on the bulk of aspects, we actually agree with each other on most items. There are things that we don't disagree, and there are things that we need the courts or the regulators to intervene on and discuss. But I don't think this is one of those items. So that's my plea. I'm done preaching, everybody. That's my plea. I'll preach one last bit, is that is increased usage of DCRS. I think, again, there's a host of benefits. I'm not going to go through each here now, but we know for you and the consumer, there is a host of benefits. So always kind of default to DCRS proposals, and if that doesn't work out for you, you can move on to non-DCRS proposals. I'll stop here and pause for any questions if there may be. Thanks.
Thank you, Mohammed, so much. As we wait for questions, Reinhard, I see your hand. Just give me a moment. Mohammed, just from the CASA side, thank you for everything. Also on BASA side, I know we won't always see eye to eye on everything, but I believe when we talk to the outside world, I think we must start using one voice to firstly protect debt review as an industry, because it benefits everybody, including the consumer. But when we have differences that we discuss them internally, and CIF is a wonderful platform for that. And if you have issues, with PASA members, with all of that, please do raise it with the CASA. We've seen a lot of resolve happening, especially this year, when we take hands and resolve things. I don't think sometimes we are so angry in the moment, we forget that we are there to look at the consumer, that we need to rehabilitate back into the credit market. And from starting to talk more frankly, we have seen that happen a lot more. So, Reinhard, on that point, you are welcome to talk. I think you're still muted.
Yeah. Hi, Mohammed. Thank you, Casper. Hope all is well with you, Mohammed. We've had our disagreements and our agreements in the past. Yeah, my question to you, it's all very well when we say let's look at doing everything via the NCT. All right. Now, when we look at our task team agreements, where we say with a consumer, let's say the consumer's lost their job, where we can give a 3-month concession or whatever it is till they find it. We do have some of the banks that will simply refuse and terminate. Although it's within the task team agreements, they say, well, if you want to change anything, you need to go get a variation order. Knowing full well it's an NCT order, so the client remains terminated. And this is a problem. So we can't do a variation on the NCT order. The only way we can do it is via a match court. So when that's one of the problems we have. And then another thing that we found recently, where when we request our COBs, quite a few of the banks are no longer putting original default amount and date of default. And that also causes a problem, especially when you're looking at doing cascades, where we need to make sure Section 1035 is not sort of abused. So any thoughts on that, and how can you address that with your Basel team?
Thanks, Reinhard. Good to hear your voice again. And yes, I'm sure we will have many more agreements and disagreements. So I think 2 important points, Reinhard. The first is around failure to adhere to aspects of the task, in particular when there's a change of circumstance. I think as an industry, we need to push, and this is something we've started, right? And it's something the DCRS said to us they're going to look at the minute they've concluded the task team review. And I guess that makes sense as well. But there's a separate, I don't want to call it a committee, because in my mind it should be a little broader than a committee that will be formed, called the task team enforcement. And I believe once we've concluded the task team agreement review and all that's done, and that's hopefully, I think as Casper said, this year, I don't know, touch wood, it may not be, it may be. I know some subcommittees have finished their work and some are still ongoing. But I think as an industry, we can all together push for that enforcement subcommittee once this is done. I think that will help with the compliance, but especially pertaining to the annual review, or rather the change in circumstances. Then I also agree that the mandate in NCT needs to be changed. Unfortunately, that's a legislative change, and unfortunately, we all here know very well how long that takes. So I think again we've got to keep singing that song. That answers the first bit. The second bit, around Section 1035, I just need to highlight that matter is currently sitting with the SCA, and as you guys, it's pending litigation, right? So our understanding is that while there may have been an order issued out by a high court, the matter now sits with the Supreme Court of Appeal, and the matter has not been fully judicially decided upon. And therefore, we believe it's premature to adopt that high court decision while the matter is still pending at the SCA. And we therefore believe that at this point we will not, each bank will adopt Section 1035 as per their interpretation, and that largely aligns with PASA's interpretation in the court papers at both the High Court and currently at the Supreme Court of Appeal. So I guess what I'm saying is let's wait for the method to be fully decided upon, and we've got absolute final clarity on where 1035 sits, and we can thereafter look at implementation aspects thereof. I hope that makes sense. And I know Reinhard's not going to be fully satisfied, but happy to deal any follow-ups offline, Reinhard.
Yeah, no. Just very quickly, I was not really referring to, because basically when it's in our task team agreements that once the order is done, it cures default. That's not what I was referring to here. What I was referring to, because a lot of these consumers, when they actually fall out of the debt review space, they haven't even got a court order. So, and quite often when you go to these collectors, they've either bought the debt, they'll just take on a particular debt, and that's the new point that they look at. So, I've had numerous fights with Lynn and Main, and I've won quite a few of them recently. But if we actually have an original default date, let's excuse, and the client has fallen off the wayside, then at least we have something that we can work on, is what I was referring to. So I know the Chantal Scott case, but I'm going to just have to wait, and there's not much I can do about that one. But the point I was bringing, where we actually know the amount of default that the client was in when the client actually fell into default originally. We can worry about the court and curing those things later.
So let me just jump in there, Mo, before you take that on. Reinhard, I think when we do credit checks, it is clear when is the consumer's pay date. If it's on the 25th of the month and we see there's a default from September, we can take that as a date of default. So it's not only, yes, I know credit providers must put that clearly on their COBs as per the task team, and I'll address it in the DCRS training as well. But I mean, from a DC side, once again, this is now doing our job. I think sometimes we forget, and you know, I don't want to say we become lazy, but I think it's very important that we look at those credit checks, note when the date of default in line with those credit checks are, and calculate it from that date, you know, which isn't always too difficult when you reflect it on from the credit check and the COBs. So I'm going to leave it there unless you want to add on, Mo. I think the Scott judgment, yes, it's still pending and probably only going to be heard in the first or second quarter next year. But once again, we fall back to the TTA 1 agreement. If a credit provider does not accept your DCRS, you could fall back to 1035 and add the interest back, and that will resolve to deal with the imbalance issue, or that the account leads to eventual satisfaction rather. And I think it's important that that all debt counselors do the affordability as they should, you know. Look at your credit check, refer to regulation 24.4, and deal with each account as you should. Mohammed, did you want to add anything further to Reinhard's follow up?
I think it's well covered. Thank you, Casper.
Okay, if there's no other questions, any other questions? I see you, Susan. You have commented on the side. I think there's a lot that we need to address. You know, industry has created a lot of workarounds, and that is the point of TTA 2, to bring everything up to date. And once that is up to date, you know, the watchdog to be created once TTA 2 is done, to deal with these double standards. You know, I know we see things from our side. Believe me, I've fought lots of times with credit providers on double standards, but also they can fight with us on double standards. So I hear you on the 17.3, and I hope the TTA that are once again gonna submit that the CASA brought up in CIF, and we agree that it needs to be updated specifically for these 17.3 issues and other issues. You know, we can't leave things outdated, and hopefully with this watchdog, we can also on an annual basis update things, because things have been left too long by industry. And it's when we leave things too long that these unfortunate things sticks its head out very ugly, and we need to deal with the fallout. So I hear you on that. And we know there is a lot of sticking points, but please do submit your views to DCRS, Susan. Bring your points across clearly, and please not in an attacking format, but what the issue is, what you believe the resolve would be, and only through these open discussions can we raise it at CIF as a DCRS view to deal with it. But don't just attack things, come with solutions. And that is the point of all of that. Mohammed, I just want to thank you for your time and your effort and everything you guys are also doing in the background. I think there's a lot of things that we don't appreciate. And since I've been on DCRS, I've seen the amount of work that goes into the back end. And believe me, you're going to hear a lot of me, and I'm going to push you for deadlines. But thank you for today, and thank you for the feedback from BASA.
No, thank you, Casper. And I think thanks largely to DCRS. I think we enjoy this working relationship. Long may it last, and I'm sure we have many other items to debate as we move along. But as always, constructively and responsibly, and we'll get it done. Thank you.
Thanks, Mo. Have a blessed one. Okay, then let's move on to our DCRS training. So just to give you a bit of background, where did this come up? So obviously there was an issue by two actually of the major credit providers not accepting DCRS proposals. And, there was a lot of friction. And I think after quite a number of debates, I myself actually flew up to Joburg. I am based in the Eastern Cape, so I flew up to Joburg, had meetings with that specific bank, and then it became clear that we are missing each other. From banking side, they seeing all of these tags on DCRS, all of these different DCRSs posed, and from a DC side, when a consumer is short, we can see there's an amount short. And how much would we need for DCRS to solve. So the system providers have given us results for that. But unfortunately, from a credit provider side, when they see all of these multiple proposals being queried on DCRS, the question becomes, why is the DC querying this? And some system providers load the balance on top. Some system providers loaded or deducted from the expenses, and now you've got multiple gross incomes that is submitted, and when you eventually do that proposal, the bank sees it as manipulation, because unfortunately, coming back to the question of abuse, there is some DCs that are submitting proposals, DCRS proposals, that goes to the NCT on acceptances where they have changed the income. So let's say a consumer earns 40,000, but they want DCRS to solve, so they reduce that income to 32 without any proofs, and DCRS solves at 0 rate. And there is some DC books with 100% 0 rates, 100% rates where the bottom on the vehicle is being reached, so the prime +2, and the bottom on bonds, together with 0% interest rates across the board on all the accounts. Now, that is almost impossible if you look at how DCRS is built. If you do direct a correct proposal, it should be accepted. So what we've addressed with the credit provider, don't treat all debt counselors the same, especially when it comes to DCRS members. Our members are acting ethically. There's debt counselors that really submit real proposals there. And you can't treat them the same as the DCs that abuse. So target the DCs that abuse, but do not treat all debt counselors equally. So on that, DCRS said, we hear you, credit provider. Let's give a training to our members to look at how to do the DCRS properly. So to give you the background, why DCRS is used, DCRS was created in the task team agreement, in the guidelines on the different debt counselling rule sets. So if some of you were already practicing back in the day, I remember 2009, 2010, 2011, 2012, we were in court with the banks every 5 seconds over things. So what is DCRS? DCRS is not just a system. It is a structured concession framework that is agreed by the industry stakeholders to ensure 4 main things: to ensure fair restructuring, realistic concessions, eventual satisfaction of the debt, and improve acceptance rates so that we don't get so many counters and opposition. So we need to emphasize DCRS is there to improve uniformity, fairness, and acceptances, but only when it is used correctly. So in the beginning, there was a lot of different rates for different credit providers. So the one bank wants 9%, the other wants 12%, next one wants 7%. So how is that fair? How do you send a proposal with the exact same outstanding balances with different interest rates? Because that's what the different credit provider accepts. So DCRS then create that platform that there is fairness to all credit providers. And let's just jump back. Let's look at Section 86. What does it say? Well, Section 86 actually guides the entire debt review process. Step 1 is to determine if a consumer is over indebted, and that's in terms of Section 86.6. So step 2 would be to apply 86.7c to deal with the over-indebted consumer when they are over-indebted. So we can only extend the terms, reduce the installments, and recalculate the payments, and then we rearrange all the obligations. So basically, in summary, DCRS is actually the practical implementation tool to achieve Section 86.7c. But if you note, nowhere in the Act does it allow for reduced interest rates. These are concessions by the credit providers that we've agreed to get those reductions, to make things solved, to lead to eventual satisfaction for the consumer. So let's look at the background. In 2010, the task team committee was formed to streamline the debt review process, because it's no point credit providers waste millions and millions of rands in opposition, and we don't know what a reasonable concession is. So Circular 2 of 2015 basically formalized that guidance and the concession that was developed between industry stakeholders. Then there's a massive benefit for the consumer that can actually lead to eventual satisfaction. So we must remember, what is our end goal? Our end goal is not to keep consumers in debt review forever. Our end goal is to rehabilitate the consumer back into the credit market, to allow for that consumer to stick their hand up and say, listen, I want to pay my debt, but unfortunately, I can't afford to pay my debt and afford to live. And this was the starting point of DCRS. So step 1, you need to assess the budget, and let's just go to the guideline. For some of you that are on here, you are seasoned debt counselors, and for some newer ones, maybe this is just an update. For the older ones, these are some points that we need to look carefully at, especially when we look at that gross income, and I'm gonna explain why. So let's look at the gross income. It's normally your statutory deductions deducted off of the gross income, then the non-statutory deductions, and then something that sticks its head out badly, especially in government and municipalities, is that employer deductions are actually exceeding 25%. That is legislative in law. There's currently a task team that has moved its way through KZN. It's currently in the Eastern Cape. I believe they're either in the Free State or Gauteng next, where they are addressing this issue. So if you are picking up salary advices where the employer deductions is more than the 25% cap, please bring that to the attention of the CASA so we can share it with the relevant people that need to deal with it. I mean, I've seen a payslip where a consumer needed to net 32,000 Rand, but paid into their bank account is 200 Rand. It is absolutely horrific what is going on out there. So then we're going to add the additional income, overtime, rental, commission income, additional household income, and that's in terms of Section 78.3b. You get your net income. You then minus your household expenses as is. So I'm going to come to a next slide And remember, whatever the consumer gives you remains in the first column, and that must stay like that the whole part through. Then you're going to less your existing creditor obligations in terms of the credit bureau information and what the consumer statements are saying. You're going to then see, is the consumer over indebted or is he not? Then in terms of section 86.6, a debt counselor must conduct an assessment of the consumer's financial position to determine whether a consumer is over indebted. So it's not may, it is must. And how can you do that without payslips and bank statements? And remember, at this point, look at things where it can be adjusted. There is some consumers that don't qualify for debt review. That's just living exorbitantly, and it must be pointed out that way. One of those examples is a consumer, a single person, putting in groceries of 10,000 Rand. That might be a bit excessive. Then we can cut back and the consumer is actually not over indebted. So I'm going to thank my NEC. They put together actual consumer from one of our DCs serving on our NEC, and to utilize this as a real example for this exercise. So in this example, the consumer earned a gross income of 35,000. They had statutory deductions of 14,000. As you can see on the screen, I'm not going to read out all the Zuma numbers. Now the recording goes live, and I embarrass myself. So the net income then is the 20,000, less the household expenses of 16,000, and the debt repayments of 15,000. We see there's then a shortfall of the 10,000. So with what the consumer has left, the consumer is clearly over indebted because there is a shortfall of 10,000 Rand, meaning the consumer only has 4,753 Rand 72 cents left. So step 2, we're going to reach out to the credit provider with a 17.1 letter to supply us with the COB, and that's in terms of Regulation 24.224. And remember, accurate data makes for a successful DCRS. A credit provider must provide outstanding balances, arrears, interest rate, fees, installment, and default date. If there is no COB, use Regulation 24.4 with the credit bureau information. You cannot submit DCRS with estimates, and this is one of the issues we've also seen where estimates are used. So for the purpose of this example, you will see there is a column here in the middle. That is where you fill in your COB data. Remember, you must accurately fill in the balance, the rate, the interest rate, naturally, the fees, the default date, the insurance, and service fees where applicable. If you capture something wrong, you will automatically get a decline. So let's move forward. We then have received our COB, we've captured it, we've looked at what the consumer has provided us, and now we're going to look if we can reduce any luxury expenses or non-essential spending. A result, this will give us the amount that feeds into DCRS, what we are gonna give to DCRS. So if DCRS does not solve, we can reduce that luxury expenses and non-essential spending. And that is where we get these two columns. So remember, I referred to what the consumer gives you originally must remain the same at all times, the actual information. And that is why we've got two columns on our systems and on DCRS. Then on our proposed side is where we're going to make the amendments. And I'm going to highlight specifically, if you can remember, we had 4,753 Rand and 72 cents left. We made some adjustments on the expenses, and now we only have, now we have a bit more left, 4,917, and DCRS solves, and we can move forward. So I want you all to note the following. Section 86.5 says, once a consumer applies for debt review, both the credit provider and consumer must comply with any reasonable request by a debt counselor to facilitate the evaluation of the consumer's state of over-indebtedness and the restructuring of the consumer's obligation. So both the consumer and the credit provider must, not may, must cooperate. So if the CP refuses to provide documents, or if the consumer withholds or distorts information, you cannot proceed with DCRS. Step 4, make sure all your information is captured accurately. You know the differences between the NCA account type, creditor account type, secured versus unsecured. Look at where balloon payments are. Yes, jumbo loans is currently in progress, hoping as soon as cascading is finished. And obviously we know step-up payments and the vehicle finance terms is a bit of a concern because they do not solve in the DCRS terms. So if any of these are incorrect, DCRS will miscalculate and we will not get the correct information. So make sure your agreement classification is correct. Then we move on what to know about DCRS. So for you that are full members or long enough, you would have a DCRS booklet, the task team agreement summarized nicely, and we've got a nice part in the DCRS terms extension rule. If you understand these rules, you will understand DCRS. However, we must note that vehicle finance, VAF, since the TTA has been updated. So remember, originally it is up to 1.5 times of the contractual term, subject to a maximum of 84 months from inception. Currently, that's sitting on 90 months without a balloon and 100 months with a balloon, and that is from inception. So remember, you don't calculate it from when the consumer enters debt review. It is from when that vehicle was purchased and when that contract started. So if we look 12 years ago, 13 years ago, the longest vehicle term was 36 months. Now we're sitting at 96 months in some cases with balloon, and then we also sat with the step-up payments. So naturally those things won't solve within the DCRS, and which would be the next point of topic on the DCRS subcommittee. Please remember your rules. We've also seen a lot of chatter about the unsecured terms, but balances up to 1.5, max of 18 months, a balance between 1.5 and 3.6, max is 36 months. Then any balances above that should be 60 months. And then naturally we are busy discussing the jumbo loans. That wasn't part of these original terms and the extensions. So this is where the interest rates and that will drop to try and solve within these terms. So if you've not seen a DCRS proposal, you will note the first part of the proposal will reflect the original terms that you must capture correctly. And we can see in this consumer's proposal, it's really massively benefited the consumer. We can see the interest rates dropped 27.75% on that FinChoice account, down to 10.95%. And then within 49 months, that account will solve. Some accounts 52 months, and 29. And naturally with the cascade, those terms will also even be shorter. The payslip information was captured correctly from get-go. Your proposal was correct and you still get a decline. Please raise this with the CASA and we will help in solving that matter. We've seen a lot of declines. And remember, if we go back to TTA, the TTA 2.3.11a says a CP must accept a DCRS proposal where it solves. If they decline, they must give you in writing wrong balances, inflated expense, or does not solve in writing. And we do see there's some microlenders that are not participating. So always request the decline in writing. If you feel that your proposal was correct and the credit provider did decline it unreasonably, your payslip was loaded correctly, all your information was correct, please raise it with the CASA. Then from that point, if not everybody has accepted, you refer the matter to a magistrate court, and then the court may confirm the proposal where there's no DCRS concessions, the rearrangement obligations will obviously refer to Section 86.7, where we can only reduce installments, extend the term, and only by consent of the credit provider can we reduce those interest rates. Then if everything is consented, it is recommended to refer to the NCT to confirm the proposal and rearrange the obligations accordingly. So if you are a DCRS member, please reach out if you don't have the booklet, that we can send you the booklet. And as soon as TT8 version 2 is released, we will obviously update that booklet to the latest, and really, I don't want to say dumb it down, but to simplify it so that you can understand what is said in that TTA version 2. So I want to leave you with this, that remember, DCRS is not about getting the lowest installment or interest rate. It is about mathematical solvency, legal compliance, fair concessions to everybody, and it must lead to eventual satisfaction of the debt. Our goal is to rehabilitate that consumer back into that credit market sooner rather than later.